Welcome back to Talk Tickers. If you're listening to this, you are probably looking for the signal amidst the just the absolute noise of earnings season. We are the show that cuts through the fluff, we skip the corporate jargon, and we get straight to the numbers that actually move your portfolio. I'm your host.
And I'm joining you as always to break down the mechanics behind the movement. And today is going to be an interesting one.
Yeah.
Because we are looking at a classic turnaround story. I mean, in real time, we're dissecting a legacy brand attempting to perform open heart surgery on itself while, running a marathon.
That is a bad image, but yeah, that's pretty accurate. Today, we're fixing our gaze squarely on the fast food sector, specifically the Q4 and fiscal year 2025 earnings from Wendy's.
Ticker WEN.
Ticker symbol WEN. And let me tell you, if you were watching the tape on the morning of this release, you probably got whiplash.
Oh, it was a violent session.
Yeah.
I think we need to talk about the vibe check immediately.
Yeah, let's start there.
Because the price action, it tells you more about the psychology of the market right now than the actual P&L statement does.
Exactly. So let's set the scene. The print drops pre-market. The headline numbers, which we will get to, they look rough. The guidance for 2026 looks, frankly, even rougher. The stock immediately tanks. We are talking nearly 7% down in the pre-market trading session.
Yeah, it looked like it was going to be a bloodbath. It was testing support levels we haven't seen in, years?
Sure, it was looking like a liquidation event, but then the opening bell rings, the volume starts pouring in, and something completely counterintuitive happens.
Right, the stock doesn't just stabilize, it rips. It just rips higher.
Rips. It claws back every single cent of that 7% loss and actually closes the day up nearly 3%.
2.89% to be exact. And the volume was heavy.
So heavy. 3 times the average daily volume. This wasn't retail piling in. This was institutional money stepping up.
And that is the narrative hook for today. Why? Why did the market buy the dip on what looked, objectively, like a disastrous quarter?
It's the classic kitchen sink quarter. That's what this is. You have the interim CEO, Ken Cook. He comes in, looks at the books, looks at the operations, and basically decides to, clear the decks.
It's the bad news is good news phenomenon, but only if that bad news is fully priced in and the uncertainty is removed.
Right.
Management reset the bar so low for 2026 that the market essentially just said, okay, the worst is over. We know where the floor is now.
And they launched this massive turnaround strategy they're calling Project Fresh, and that is what we're going to unpack today.
I'm very curious about this Project Fresh.
So our mission for this deep dive is clear. We are going to unpack the ugly Q4 numbers, and trust me, they are ugly. We're going to look at the massive lowered guidance for 2026, the plan to close hundreds of stores, which is a huge headline.
It's a huge headline.
And try to figure out if this Project Fresh is actually a fresh start or if it's just, a coat of paint on a crumbling building.
All right, so let's start with the results snapshot. Give us the headlines. Let's see how bad it really was.
Okay, let's rip the Band-Aid off. Headline financials. Adjusted earnings per share, or EPS, came in at 16 cents. Now, the consensus on the street was looking for 14 cents. So technically, that is a beat.
A 2-cent beat. But we really need to contextualize that. That's not a real operational beat.
Right, a 2-cent beat. The GAAP EPS was 14 cents compared to 23 cents the prior year. So a big drop there.
A big drop.
Revenue came in at $543 million, which was also a slight beat against expectations of around $536 million.
Okay.
So on the surface, if you just glanced at a terminal, you see green arrows, EPS beat, revenue beat, but then you look at the sales metrics and that is where the floor just falls out.
This is where you had to separate the financial engineering from the operational reality. The adjusted EBITDA for the quarter was $113.3 million. For the full year, they hit $522.4 million.
Yeah.
But the ugly truth, the real story, is in the global system-wide sales. They plummeted. Negative 8.3% year over year.
Negative 8.3. That is not a drift. That is a crash.
It's a cliff dive.
And the divergence between the domestic U.S. market and the international market is it's just stark.
It's like looking at two different companies, effectively. In the U.S., same restaurant sales.
Yeah.
The holy grail metric for any retailer crashed negative 11.3%.
Double-digit decline.
Double-digit. That's driven by traffic just evaporating and some really bad marketing misses. But if you look overseas, international system-wide sales actually grew 6.2%.
So international is the lifeboat right now. It's the only thing keeping the ship afloat.
It's the only engine firing. But because the U.S. is such a massive chunk of the pie, we are talking about the vast majority of the revenue base, that international growth just gets completely swallowed up by the domestic failure.
Yeah.
You can't grow your way out of a U.S. recession with Romanian burger sales alone. It just doesn't work that way.
And we should probably mention capital returns because that plays into the EPS beat. They returned about $330 million to shareholders in fiscal year 2025.
How'd they do that?
Dividends and buybacks.
And there it is. That explains the EPS beat. If you buy back enough of your own shares, you reduce the denominator in the EPS calculation, and your earnings per share look better even if your net income is, struggling.
So financial engineering saved the headline beat.
Absolutely.
Right.
But the top line demand, the actual number of people walking in the door in the U.S. has fallen off a cliff. That is the reality management is dealing with.
Okay, let's unpack Project Fresh. This is the big turnaround plan. It's got, 4 pillars, fancy corporate names, the whole 9 yards.
Of course it does.
But before we get to the solution, we need to understand the diagnosis. Why did U.S. sales tank 11%? Was it the economy? Was it Ozempic? What happened?
Management was surprisingly candid about this, which I think is another reason the stock recovered. They didn't blame the weather or the consumer macro environment entirely, which is the usual excuse. They admitted they messed up the calendar. In 2025, they front-loaded their marketing spend.
What does that mean exactly, front-loaded?
They blew the budget. They spent all their marketing dollars in Q1, Q2, and Q3 trying to drive traffic, maybe chase some short-term numbers. By the time they got to the crucial Q4 holiday season, the cupboard was bare. They didn't have the media weight to drive people into the stores.
They ran out of ammo right before the big holiday push. That's marketing 101, what not to do.
It's a huge misstep.
Yeah.
And to make it worse, they were lapping a very, very difficult comparison. Remember the previous year?
That SpongeBob thing.
Exactly. They had the Krabby Patty collaboration, the SpongeBob partnership. That was a massive cultural hit. It drove huge traffic.
Mm-hmm.
This year, in Q4, they had nothing comparable. So you've got no marketing money, and you're fighting against the ghost of a massive hit promotion from the year before.
It just creates this massive base effect distortion in the numbers. It makes a bad situation look catastrophic.
For sure. But there is something deeper here, I think, regarding the product itself.
Go on.
There was a quote that stuck out to me regarding innovation. The management team admitted that there was, and I'm quoting here, zero hamburger innovation in 2025. Zero.
That is stunning. For a place whose entire brand identity is built on fresh, never frozen beef, to have zero innovation on your core product for 12 straight months it's operational negligence.
It really is. The menu just went stale. They were relying on gimmicks or perhaps focusing too much on the breakfast day part, which is a bloodbath, but the core lunch and dinner burger customer just got bored.
In QSR quick service restaurants, novelty is a currency. It really is. If you aren't offering something new, the customer just drives across the street to the guy who is.
And the timing was brutal. They said sales bottomed out in October. That was the trough. Okay, fine. They saw a slight improvement in November and December, but then January 2026 got hit by weather and was down 8%.
So they are entering this big turnaround on the back foot. There's no momentum.
None. Which brings us to the surgery, part 2 of Project Fresh. This is what they're calling system optimization.
And in plain English, that means what?
It means closing stores, and not just a handful.
We aren't talking about trimming the hedges here. We're talking about chopping down entire trees.
That's a good way to put it.
Yeah.
The guidance is that they plan to close 5 to 6% of U.S. restaurants.
5 to 6%.
Yeah.
Okay, do the math for us. What does that actually mean in terms of locations?
If you look at their total U.S. footprint, that works out to be roughly 240 to 360 locations.
Wow.
That is a significant chunk of real estate being taken offline.
That sounds drastic. Usually when a big retailer announces they're closing 300 stores, the headline is Retail Apocalypse. Why is this being viewed constructively here?
Because of the quality of those stores, the rationale, and I think it's a sound one, is to improve the overall health of the franchisees. Look, if you have a store that's doing low volume, say, under $1 million in annual sales, it just drags down the whole system. It requires corporate support. It dilutes the brand perception because it's probably an older, uglier building, and it's most certainly losing money for the operator who's running it.
Right. It's a drain on resources and morale.
Exactly. So by closing these underperforming units, you instantly raise the average unit volume, or AUV, of the entire remaining system.
It's addition by subtraction.
Precisely. Now, look, there is a financial cost to this. We should be clear.
Of course.
They are expecting a $15 to $20 million drag on adjusted EBIT because when you close a store, you lose that royalty stream.
And potentially some rent if they own the property.
Exactly. But the bet is that the long-term margin improvement for the system and for the franchisees outweighs that short-term revenue hit. It's about getting the system healthy enough to actually grow again.
And part of this surgery, this system optimization, it involves the day parts. We've talked about breakfast on this show before. The breakfast wars have been just brutal.
Oh, a total meat grinder.
You've got McDonald's, Taco Bell, Burger King. Everyone is fighting for that morning commute dollar. What is Wendy's doing there?
This is a subtle, but I think very important pivot. For a long time, the corporate mandate was everyone does breakfast, period. Now, they are allowing franchisees flexibility. If you're in a low traffic area where opening at 6 a.m. costs you more in labor and electricity than you make in egg sandwiches, you don't have to do it anymore.
That seems like common sense.
It is, but it's a big shift. They're letting franchisees cut those unprofitable breakfast hours to reinvest that labor into the late night bucket.
Late night, the fourth meal.
It was their best performing day part in 2025.
Really?
Yes. It has higher margins and frankly a lot less competition than the morning commute. Think about it. At 7 a.m., you have 1,000 options for coffee and a bite to eat. At 11:00 p.m., your options are drastically limited.
Good point.
Wendy's is realizing that their brand equity, fresh beef, heavy, satisfying food, it plays a lot better with the late night crowd than it does with the morning commuter who just wants a quick coffee.
So they are pivoting resources from the morning grind to the midnight munchies.
That's the play, which leads us nicely into the brand revitalization. That's part 3 of Project Fresh. They're calling it the Biggie pivot. And this is all about value perception.
Okay, value. This is key in this environment.
This is the value architecture piece. The whole industry has been addicted to LTO's limited time offers. A flash sale here, a 2-for-5 deal there.
It's confusing for the customer.
It's confusing, and it trains them to only buy when there's a deal. Wendy's is trying to move away from that short-term discounting toward permanent value tiers. They want to train the customer to know exactly what they can get for a specific dollar amount anytime they walk in.
They're building a ladder, a value ladder.
Exactly right. They are launching Biggie Deals at 3 specific price points, $4, $6, and $8.
Okay, what's the strategy behind those numbers?
The $4 tier is your snacking driver. It's the traffic driver. Get people in the door for a wrap or some tenders.
The impulse buy.
The impulse buy. The $8 tier is what they're calling the abundance meal. That's for your hungry customer. 2 sandwiches, fries, a drink. So they're trying to capture the customer who just has $5 in their pocket and the customer who wants a full-on feast.
It's interesting because at the same time, they're trying to reposition as the quality option in QSR. They're calling it the everyday upgrade. How do those two things, how do they coexist, value and quality?
Right. It's a tricky balance. They know they can't win a pure price war with McDonald's on scale. McDonald's just has too much purchasing power on their raw ingredients.
Impossible to compete on price alone.
Impossible.
Okay.
So Wendy's has to win on value for money. Not just cheap, but worth it. So alongside these price points, they are rushing that menu innovation back into the pipeline.
Okay, so they're trying to fix the staleness problem?
Immediately. We mentioned the lack of burger innovation. Well, they are fixing that right now. We have the immediate launch of the cheesy bacon cheeseburger.
Can't go wrong with that.
It's classic comfort food. Crucially, it uses existing C-stock keeping units, so it's easy for the operators to execute, but it feels new to the customer.
Smart. What else?
A new chicken tenders ranch wrap. And, this is for the dessert fans, the Girl Scout Thin Mint Frosty is returning.
That was a huge hit.
Huge hit. But it's coming back with a new fusion option.
What's a fusion option?
I think it means they'll blend other toppings into it. The key is that fusion concept allows for upselling. It adds $1 to the ticket. And looking further into 2026, they mentioned upgrading their actual core ingredients. New chicken fillets and new buns are coming later in the year. That is a direct response to that stale menu criticism.
Yeah.
They're trying to physically improve the product to justify the price point.
And they are shifting how they talk about it, right? The marketing strategy is changing.
Big time. The marketing spend is moving heavily to digital and social media. They said they want culturally relevant engagement, not just generic TV commercials.
Which is smart because their target demographic for that late night push isn't watching cable news at 11 p.m.
No, they're scrolling TikTok. They have to meet the customer where the attention actually is.
Okay. So before we get to the guidance, which is the massive elephant in the room, let's just quickly touch on part 4, the international engine. We said earlier this was the one bright spot.
It really is the growth story. I mean, 21 consecutive quarters of growth internationally, that's over 5 years.
That's incredible consistency.
It is. They opened 159 new restaurants in 2025 and had 121 net new units. That is a record for them.
And they are expanding into new markets, right? I saw a list.
Yeah, some interesting ones. Australia, Romania, Scotland, and even Armenia.
It feels like they're planting flags all over the place.
The strategy is globally great, locally loved. They are using this international success and the cash flow from it to, well, to help fund the turnaround in the U.S. It proves the brand works. They just need to fix the operations in their home market.
It's a good point. International markets also tend to have newer assets, right? The buildings are new, the tech is better.
Exactly. The buildings are new, the kitchens are modern, the technology is built in from day one. In the U.S., you are dealing with a legacy fleet of stores that might be 30 or 40 years old. It's a different beast entirely.
Okay, let's talk about the kitchen sink. The 2026 guidance reset. This is where the rubber meets the road. Management explicitly called 2026 a rebuilding year.
And when a CEO says rebuilding year, investors, they translate that to expect absolutely nothing good for the next 12 months.
Right. Don't get your hopes up.
And the numbers back that up completely. They guided global system-wide sales to be flat.
Flat. After a big decline in 2025, that means we're looking at a 2-year period where the top line essentially goes nowhere.
Correct. And it gets worse. They are guiding adjusted EBITDA to a range of $460 million to $480 million.
And for context, what was FY25?
FY25 was $522 million. So they are telling you up front that profitability is going to drop significantly.
And the EPS guidance, that was the real shocker. The street was previously looking for what, something like 85 cents a share?
Around there, yeah. The consensus was about 85 cents. Wendy's came out and said, no, it's going to be between 56 and 60 cents.
Wow. That is a massive reset. That is nearly a 30% haircut on earnings expectations.
It's huge.
Why? What's driving that big of a drop?
Margins. It's all about the margins. They are baking in commodity inflation of about 4%. Beef prices are still very high, and they're expecting labor inflation of another 4%.
The double whammy of cost increases.
The double whammy. Plus, you have the cost of the turnaround itself. Marketing costs money. Remodeling costs money. Severance for all those closed stores costs money. It all adds up.
So, to circle back to the very beginning of the show, why on earth did the stock rise on this news?
Because uncertainty is worse than bad news. It always is.
Yeah.
The market was terrified that the bottom was bottomless, that sales would just keep falling and falling. By coming out and saying, here is the floor, it's 56 cents of EPS, it's flat sales, we are closing the bad stores, management removed all of that uncertainty. They cleared the deck.
They defined the bottom.
They defined the bottom.
Yeah.
Now, any beat in 2026, however small, looks like a huge victory. They lowered the bar so much that it's almost impossible to trip over it.
The old bad news is priced in dynamic.
Exactly.
Yeah.
Investors looked at that 7% drop pre-market and said, okay, that's the penalty. Now, in this lower price, is it a buy? And clearly, enough big institutional money decided that a clear deck and a credible turnaround plan was worth a shot.
So they aren't buying the 2026 story.
No, not at all. They're buying the 2027 story, not the 2026 reality.
Okay, let's pivot to the investor context then. We need to look at the financial health of the company beyond just the P&L. Let's talk balance sheet. How is it looking?
It's a bit stretched, if we're being honest. The net leverage ratio is 4.8x.
And their target range is what?
Their stated target range is 3.5x to 5.0x, so they are right at the absolute ceiling of their comfort zone.
Is that dangerous in this environment?
In a high interest rate environment, it's not ideal, put it that way. They recently had to refinance some securitization notes, $450 million worth, and they did it at 5.4%.
That's not cheap money.
No, it's not.
Yeah.
And that interest expense eats directly into free cash flow. But to their credit, they do have cash flow. They are guiding for free cash flow of $190 million to $205 million in 2026.
And that cash flow is absolutely critical because of the dividend, right? They maintain the dividend at 14 cents per quarter.
This is where it gets really tight. If you do the math, 14 cents a quarter is 56 cents for the full year. And their EPS guidance for 2026 is, as we just said, 56 to 60 cents.
So the payout ratio is basically 100% of earnings.
On an earnings basis, yes.
Yeah.
Which looks scary. But you have to remember, dividends are paid from cash flow, not from accounting earnings.
That's a key distinction.
A very key distinction. And since their free cash flow guidance of roughly $200 million does cover the total dividend payment, it's safe. for now.
Uh-huh.
But there's zero room for error. If they miss that cash flow guidance, that dividend immediately becomes a target for a cut.
And what about spending? If they are this cash constrained, where is the money actually going?
Well, they're pivoting their capital expenditure. This is interesting. They are shifting capital away from build to suit.
What's build to suit?
That's where corporate basically acts as a developer. They build a brand new store and then hand the keys over to a franchisee. They're doing less of that.
And moving that money toward what?
Toward technology.
Yeah.
Digital menu boards, app gamification, and importantly, more field support teams on the ground to help the franchisees.
They're trying to tech their way out of this.
And support their operators.
Yeah.
We have to talk about the one Wendy's mantra they kept repeating on the call.
Right.
The relationship between corporate and the franchisees has been, let's just say it's been tense. Traffic is down, costs for food and labor are up. The franchisees are hurting.
So this whole system surgery isn't just about cleaning up corporate's metrics. It's an olive branch to the operators.
It is, 100%.
Well,
By allowing closures, they are letting franchisees stop the bleeding on their worst money-losing units. By funding more field ops teams, they're trying to actively help them run better, more profitable restaurants.
and the focus on digital sales is huge here for them.
It's everything. Digital sales mix hit an all-time high of 20.6% in the U.S. in the quarter. And that's crucial because digital orders almost always have higher tickets, and they have much better margins for the operator.
Less labor involved.
Less labor, more accurate orders. If they can get that digital mix to 25 or 30%, it solves a lot of the profitability problems at the unit level.
So it's a high-stakes game of save the franchisee.
It really is. Because without healthy, profitable franchisees, the royalty stream that corporate lives on dries up and dies. They have no choice but to fix this.
All right, we have covered the numbers, the strategy, the risks. Now it is time for the segment our lawyers beg us not to do, but, we do it anyway.
This is the favorite part of the show. I love this part.
This is not financial advice.
All right.
We are going to pitch an outrageous but plausible trade idea based on the dynamics we just discussed. And I have to say this. This is for entertainment purposes only. Do not trade on this. Do your own diligence. Expert, what have you got for us?
Okay, I'm calling this trade the square patty shrink to grow leap.
I love it already. Walk us through the setup.
Okay, here's the thesis. Wendy's is essentially doing a controlled demolition of its worst, 300 stores? We know this.
Good fact.
We also know that management has explicitly told us, screamed it from the rooftops, that 2026 is a wash. They said sales will be flat. They guided earnings way down.
So the stock is dead money for a year, is what you're saying.
Exactly. Why would you buy the common stock now and just sit through 12 months of chop and sideways action of a rebuilding year? The market hates the waiting game.
Okay, so what's the trade?
The thesis assumes that by Q1 2027, two things will have happened. One, the bad stores are gone, so the overall system's margin profile is much cleaner. And two, they will be lapping the dismal comps of 2025 and the flat comps of 2026.
The bar for comparison will be on the floor.
The bar will be buried underground. So the trade is a 2027 long call vertical spread.
LEIP, a long-dated option.
A long-dated option, exactly. You go way out in time. You bypass the entire rebuilding year noise. You are betting that by early 2027, the Project Fresh initiatives will finally have traction, the menu innovation will be hitting, and the year-over-year comparison numbers will look absolutely spectacular because the baseline is so incredibly low.
You are skipping the surgery and just betting on the recovery.
Precisely. But here is the twist to make it a true hedge fund style trade.
Ooh, I like a twist.
You pair it with a short position, or maybe just buying some puts on their breakfast-heavy competitors.
Why? What's the logic there?
Because Wendy's just gave us the signal. They're pivoting their labor and their focus to late night. They're essentially giving up on the morning commute war in low-traffic areas to own the post-10 p.m. crowd.
The stoned and drunk demographic, as we called it.
It's a very loyal demographic with, let's be honest, pretty high price inelasticity. If Wendy's successfully captures that market, they aren't fighting the fierce breakfast war anymore. So you short the guys who are still bleeding money fighting for the shrinking breakfast crowd, and you go long the guy who's about to own the night shift in 2027.
That is wild, it's plausible, and it is exactly the kind of asymmetric thinking we like to see here. The square patty shrink to grow LEIP. You heard it here first.
Just remember to keep your stops tight. Don't be a hero.
All right, let's wrap this up. Recap for the listeners. Wendy's Q4 was, let's face it, a domestic disaster. Sales down 11% in the US. But some clever financial engineering and a very strong international performance did soften the blow on the headline numbers.
The market reaction was a classic relief rally. The stock tanked on the bad news, but it rallied on the credible turnaround plan. Project Fresh is the code name for fixing the basics, closing the bad stores, fixing the stale menu, and pivoting their marketing spend.
Management has reset the bar for 2026 very, very low. Flat sales, lower earnings. It is officially a rebuilding year, so don't expect much for the next 4 quarters.
The final thought to leave you with is this. Can a legacy burger chain actually tech its way and efficiency its way out of a real demand slump? Or is the $8 Biggie deal just a Band-Aid on a broken value perception? The next 2 quarters of traffic numbers will tell us if the patient is stabilizing or if the surgery ultimately failed.
That is the question, and we will be watching those same restaurant sales numbers like a hawk next quarter. Thank you for listening to Talk Tickers. If you enjoyed this deep dive, please leave us a review. And remember,
Keep your patties square and your stops tight.
see you next time.